In this video, guys, let's talk about 4 simple market reversal candlestick trade triggers that you can use in your trading. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me. All right, so tactical video for you today. And we're talking about market reversals and some simple triggers and ways to kind of get into market reversals. So what we're talking about here is market heading lower, demand coming in on that supply-demand curve. Supply coming in on the supply-demand curve. Lots of supply, lots of supply, lots of supply. And then we're trying to look for some clue that the weight is shifting, the scale is shifting towards demand, and these are maybe some clues that we can use. And this makes life easier because if we have a structured set of triggers that help us with these market reversals, then it becomes less guessing and more, hey, I've seen something I believe is evidence to suggest this is a turn. Do I want to take it more aggressively? Do I want to wait for this? Do I want to wait for that? So these are kind of useful ways to frame and frame the trade risk as well, with your stop and all that kind of stuff. Now, are these useful standalone? No, they're far better when you have a broader idea. So there's no point in taking this in the middle of no man's land, saying, oh, it's a reversal trigger, if you're just sitting in a range, in the middle of a range, because there's no real movement. Whereas if you've taken it after heavy movement, it's actually just happening under support. It's like, I've already got an idea we could bounce off support, and I'm seeing some of these reversal triggers. I might want to express that idea in a long trade, or maybe you see it, if you're a day trader, maybe you see it after the open, after a big flush, and you think, hey, that's well extended. I might want to take a mean reversal trade back to the open. I see a trade trigger, I might do that. So the importance is where these happen. It's not necessarily these actual patterns, as valid as they are. The extra weight and the edge comes in with using them under the right conditions in the right environment, after a drive, after this, after all that kind of stuff. Okay, so let's get down to it. So first one is the most aggressive one. Let's start with aggressive. So one thing I want to say about aggressive trading. Now, aggressive tends to mean that you are trading. It can mean multiple things like size and other stuff, but in this example, or in this kind of this arena here, it's being early. So I see an aggressive trader as someone who's early in the move. Now, I used to think that being aggressive means that you get a better price, but the downside of that is you're wrong more often. And that can be the case. And I think, oh, well, actually, if you wait a little bit for confirmation, then you have more chance of success, but you have a worse price and the deal structure stops wider. That's not always the case. Now, sometimes that is the right thing to think, because if the markets are ramping to lows, you need to wait for a few signs that the demand is coming back in. Otherwise, you're just buying lows all the time, and you're getting run over. So sometimes it's worth waiting a little bit later, let someone else go first, let it come back, retest, and then kind of take a couple of rotations and sequences after the initial low. That's often better. If it's in a range-bound environment, then you can be a bit more aggressive and kind of say, hey, I want to get the first sign that this is shifting, and then I want to execute, because by the time it's moved up, there's no point. So it's a nuance of the conditions you're trading in. Okay, so first thing, number one, prior low break. So we've got a kind of down move here. Imagine this is falling lower. Now we kind of do some work to the downside. Let's say we've opened a gap lower. That's the open here, and it'll be a green candle. We kind of move lower. As we come back up through the prior low, that's often a good way to trade a reversal. So as long as it comes back up through the prior low, imagine it's day one, day two, long as it comes back up through the prior low here, and then your stop is going here, and then whatever your target may be, whether that's a couple of green candle close if you're on a daily chart, whether it's holding for the whole day if you're intraday, maybe you're looking for a scalp, whatever it may be. So it's having that low breached and then coming back up on the same day through that low. Like, okay, that's interesting. That low could be breached by a gap, or it could be breached in the day and then come back up. But it's basically rejecting a lower level. You think about what's happening is we've got supply, and demand has been found under the prior day's low. And especially when you see this after lots of red candles and down move, then you see that, you might say, okay, this could be a pullback. Now, is it a big trend reversal? Possibly not. But if it's just a pullback and you're scalping and trading off the pullback, then that can still be valid. Okay, so that's the most aggressive. Now let's go to number two. So this one is a similar thing, but this time instead of break of the low, it's the break of the prior high. So on a down move, we often get this where the high is never taken out, prior day's lowers, and it's like dung, chung, and then all of a sudden we get this kind of scenario where the next day, it could be that shape or whatever it is, but the point is it breaks the prior day's high, and you can use that as a signal to get long. Now, the downside of this is, sometimes we do get a break of that high and then it rolls back over. You've got to judge the conditions of this and you've got to be careful of that. But the upside of it, if it's a prolonged move and it's the first sign of strength, it can be like, okay, well, if we've got if we're stretched on the spring, we could have a decent pullback. It could have a 3 or 4 day pullback or 3 or 4 candle pullback if you're day trading, and that could be valid. Now, you can also use this as a trading stop as well. Some people like to do this, trail by the prior high, prior high, bang, ping, I'm out. Downside, like I say, is the move's already kind of happened, but in some extreme sort of scenarios where there's a big move, you might not want to be early, you want to wait. Because often you might get a bit of oscillation around prior day's lows, and taking that might be constantly getting stopped out. This is better for when you've got a level to work off, or where you've got ranges within, or you've got a trend line or some structure to trade, and then you see that like, I can be a little bit more aggressive, I can take it on that, I can have a go at the trade, I've got a structured stop, etc. This a little bit late to the party, but hey, in the day, if you've got a broader vision for this and the risk reward ratio is fine, great. Okay, number 3 is a large wick, pin bar, whatever you want to call them. So I like these because, especially on an intraday chart, especially when we've got structures to the trading day, is that it's tried to move lower and something has changed, the sentiment has shifted intraday, and really you've got this type of scenario, right? That's the kind of market. If you imagine there's your chart for the day, it opens, it goes lower, comes back and closes higher. That's again, any demand down there, any demand down there? Yes, big demand, supply shut off, demand's coming, bam, we've raced up, and we've often got this kind of very, very small body in a large wick. That can often be the sign of a decent reversal because it happens within a 1 day period. And so there's emergency to it. And so you might go, okay, that's interesting. Now, one little, I don't want to use the word tip, but one thing I've found is quite effective these days, and the market's evolved and changed, and some of the stuff that we talk about years ago, there's some subtleties and nuances that have changed, and you have to adjust and adapt. And very often now we get this. Very often the market will come back and test that to a certain degree, sometimes half, before reversing. So I'd say 5 years, years ago, something like that. Oh yeah, I'm putting a year on it, but a while ago we used to, isn't this precise date this stopped working? Not exactly the case. The point is we used to get these kind of wicks, and that would be real good catalysts to upside. Now we get a wick that often gets tested a bit before we get the reversal. So just be mindful of that. Sometimes waiting for the test of the wick to come back down and trying to buy in the middle of the wick is a better strategy. It's better for your stop loss as well position, rather than kind of buying straight away and then having to sit through it and having to have a smaller size because your stop is wider. So that's just something I've kind of seen and noticed and observed, watching the price action every day, well, almost every day. Okay, number 4 is the fake out trade. So love this, love this type of trade. Okay, it just makes sense as well. Logically, it's effective in the right conditions. It's just super useful. So we have this scenario, markets move lower, lower. Maybe that's a green candle there. I don't have a green one in my hand right now, but imagine this, okay? And then it breaks lower, and then the next day, it kind of closes below, but the next day we find buyers. So that's like a fake out scenario where it's put some support in here on these 3 days. Imagine these daily candles, 1, 2, 3, broke through. Everyone's like, oh, all aboard, we're going short, and everyone's getting stopped. And then the next day, we kind of rally back up. So this is a subtle difference to the normal one, or one that we see quite often, or we've talked about quite often, should I say, where you've got, ooh, these candles are awful, but you've got this scenario, okay, where you've got a wick through on a day. I mean, that's fine, and that's very, very good to see, but often we don't get that so much anymore. Sometimes we get a close below and then it rallies back up. Sometimes it takes a little bit of time, a bit like this. It's a bit muddy and a bit murky sometimes, these reversals, so it's taking that into account. So we get a day where we're closed, does some business down there, next day it opens, and nice, if it rallies straight off that open, goes back up there, then your entry can be kind of this sort of level with the long and the stop there, and structuring the trade around that if the parameters allow it, and if you think it's got enough mileage to the upside. All right, so 1, 2, 3, 4 simple market reversal candlestick trade triggers. Hopefully they are of some use to you guys. I hope they are. Take care, see you in the next one. Thank you very much. Bye bye.